You are sitting at your kitchen table, laptop open, coffee getting cold, and you are staring at a number on your screen that feels completely impossible. $60,000. That is the average down payment on a home in America right now. $60,000. And if you're living in California, New York, or any major metro area, that number could be $100,000, $150,000, even more. And somewhere between staring at that number and closing the laptop, millions of Americans make a silent decision. They decide that homeownership is for other people. People who are born into money. People who got lucky. People who are just somehow different from them. I am here today to tell you that decision is wrong. Because here is what nobody tells you. The path from where you are right now to holding the keys to your own home is not about luck, is not about income, is not about timing the market perfectly, is about having a system. A real, proven, step-by-step savings system that chips away at that number every single month until one day, sooner than you think, you actually get there. Today, I'm going to give you that system. Every strategy, every trick, every hack that real Americans have used to save their down payment faster than they ever thought possible. Stay with me through the end, because strategy number 8 is the one most people never consider, and it could cut your savings timeline in half. Let's get you into your home. Welcome back to the channel. If you're new here, we talk about real money strategies for real Americans trying to build real financial lives. No fluff, no theory, just actionable steps you can take starting today. Now, before we dive in, let me give you some perspective that is going to reframe everything. The median home price in the United States right now is approximately $420,000. A conventional 20% down payment on that home is $84,000. That sounds massive, but here is the reframe. If you save $2,000 per month aggressively using the strategies in this video, you hit $84,000 in just 42 months, 3.5 years. And if you use all the strategies I am about to share, you could cut that timeline down dramatically. Let's build your down payment. Starting right now. Strategy number 1. Before you save a single dollar, you need to know exactly what you are saving for. This sounds obvious, but you would be shocked how many people say they are saving for a house without having any idea what their actual target number is. Here is what you need to define right now, today, before this video ends. First, what is the realistic home price in the area where you want to buy? Not where you wish you could buy, where you actually plan to buy. Get on Zillow. Get on Realtor.com. Look at real listings in real neighborhoods and find a realistic price range. Second, what down payment percentage are you targeting? Here is the truth about the 20% myth. You do not have to put 20% down to buy a house. There are loan programs that allow 3% down. FHA loans require as little as 3.5% down. VA loans for veterans require 0 down. USDA loans for rural areas require 0 down. Now, putting less than 20% down does mean you pay private mortgage insurance, PMI, which adds to your monthly payment. But for many Americans, getting into a home sooner with a smaller down payment and building equity while PMI is paid beats waiting years to save 20%. Third, factor in closing costs. Most buyers forget this completely. Closing costs in America typically run 2% to 5% of the purchase price. On a $400,000 home, that is $8,000 to $20,000 in addition to your down payment. So your real target number is down payment plus closing costs plus a small cash reserve, so you're not completely depleted the day you move in. Write that number down. Put on your bathroom mirror. Make it real. Make it visible. Make it something you see every single morning when you wake up. Because you cannot hit a target you cannot see. Strategy number 2. Your down payment money needs its own home. This is not optional. This is not a suggestion. This is a non-negotiable requirement of any serious down payment savings plan. Here's why. When your down payment money is mixed in with your regular checking account, it gets spent. Not because you are irresponsible, but because it is there. It is accessible. And when an expense comes up, it is too easy to dip into it and tell yourself you will put it back later. You never put it back. Open a completely separate high-yield savings account specifically and exclusively for your down payment. Name it something powerful. Name it my house. Name it freedom. Name it whatever makes you feel the emotional weight of what you are building toward. Right now, high-yield savings accounts at online banks are paying 4.5% to 5.5% annual interest. That means your down payment fund is earning money while it sits there. On $30,000 saved, that is $1,500 in free interest per year just for having your money in the right account. The separation is psychological and mathematical. Psychologically, money in a separate account feels different. It feels purposeful. It feels untouchable. Mathematically, it earns significantly more than a regular savings account. Set up your dedicated down payment account this week. Move whatever you currently have saved into it, and never touch it for anything other than your house. Strategy number 3. Automation is the single most powerful savings tool ever invented. Here is the brutal truth about saving money manually. It requires willpower. Every single payday, you have to actively choose to transfer money into savings before you spend it on anything else. And willpower is a finite resource. Some paydays you'll be disciplined. Other paydays, when you're stressed or tired or something unexpected happened, you will skip it. And skipping becomes a habit faster than saving does. Automation eliminates willpower from the equation entirely. Here is exactly how to set it up. Go into your bank account settings and schedule an automatic transfer on the same day your paycheck hits. Not the day after. The same day. Before you can see the money, feel the money, or spend the money, it has already gone into your down payment account. This is the pay-yourself-first principle applied specifically to homeownership. Even if you start with $200 per paycheck, automated. $200 every 2 weeks is $400 per month. For $1,800 per year. That adds up to over $14,000 in 3 years before interest. Not life-changing on its own, but combined with every other strategy in this video, it is a powerful foundation. Then increase your automatic transfer by just $25 every 3 months. That small increase feels almost invisible in your budget, but over a year it adds hundreds of extra dollars to your down payment fund. Set it, forget it, and watch your down payment grow on autopilot. Strategy number 4. If you are serious about buying a home, you need a budget that reflects that seriousness. Now I know the word budget makes some people's eyes glaze over. So let me reframe it. A budget is not a restriction. A budget is a plan for winning. It is the document that maps the road from where you are to the house you want to own. Here is the framework I recommend for aggressive down payment savers. It is called the 50-30-20 rule, modified for your homeownership goal. 50% of your take-home pay goes to needs. Rent, utilities, groceries, transportation, minimum debt payments. Non-negotiable essentials only. 20% goes directly to your down payment fund. This is your homeownership investment. It is not optional. It comes right after needs. 30% goes to everything else. Entertainment, dining out, subscriptions, clothing, personal spending. This is your lifestyle budget. And for the period you're aggressively saving for a house, this category needs to get lean and stay lean. Now let's talk about specific spending cuts that have the biggest impact for Americans saving for a house. Housing costs. If you are renting, consider whether you can reduce this expense. Move to a less expensive area temporarily. Get a roommate. Negotiate your renewal. Housing is typically your biggest expense. Even a $200 reduction per month is $2,400 per year directly into your down payment. Subscriptions. The average American pays for 12 streaming and subscription services. Go through your bank statements right now and cancel everything you have not actively used in the last 30 days. Most people find $100 to $200 per month in zombie subscriptions they completely forgot about. Food spending. Dining out and food delivery is one of the fastest ways Americans drain their savings. Cooking at home, meal prepping on Sundays, drastically cutting food delivery can save the average American household $300 to $500 per month. Transportation. If you have a car payment on an expensive vehicle, seriously consider whether downsizing is worth it for the period you are saving. Dropping from a $650 car payment to a $300 car payment frees up $4,000 $200 per year for your down payment. Every dollar you cut from your lifestyle budget is a dollar that gets you closer to your front door. Strategy number 5. Your debt is stealing your down payment every single month. This is a strategy most people overlook completely because they think of debt payoff and savings as two separate goals competing against each other. They are not. They're the same goal. Here's why. Every dollar you pay in interest on credit cards, car loans, student loans, and personal debt is a dollar that never reaches your down payment fund. High-interest debt is the biggest silent destroyer of down payment progress in America today. The average American household carries over $6,000 in credit card debt at an average interest rate of 24%. That is $1,440 per year, $120 per month, paid in interest alone. Money that evaporates and produces nothing. Pay off that debt aggressively, and suddenly you have $120 more per month, plus the minimum payment amount, flowing directly into your down payment fund instead. Use the avalanche method for maximum mathematical efficiency. List all your debts from highest interest rate to lowest. Put every extra dollar toward the highest interest debt first while maintaining minimums on all others. When that debt is gone, roll the entire payment amount to the next one. The speed at which your debts disappear will accelerate dramatically as you go. Every debt you eliminate is a cash flow raise, and that cash flow raise goes straight to your house. Strategy number 6. You can only cut so much. At some point, to reach your goal faster, you have to earn more. And in America today, there has never been a better time in history to create additional income streams outside of your primary job. The gig economy, digital platforms, and remote work opportunities have created income possibilities that simply did not exist a generation ago. Let me give you the most practical and highest earning side hustle options for Americans specifically focused on saving for a house. Freelancing your existing skills. Whatever you do at your day job, someone somewhere will pay for those skills on a freelance basis. Writers, designers, marketers, accountants, project managers, lawyers, IT professionals. Platforms like Upwork and Fiverr connect skilled professionals with clients willing to pay well. Even 10 hours per week of freelance work at $30 to $50 per hour generates $1,200 to $2,000 per month in additional income. Delivery and rideshare. DoorDash, Uber Eats, Instacart, Uber, Lyft. These platforms allow you to earn on your own schedule with nothing more than a car and a smartphone. Dedicated drivers working 15 to 20 hours per week consistently report earning $1,000 to $1,500 per month in take-home income after expenses. Selling and used possessions. Go room by room through your home and sell everything you have not used in the past year. Furniture, electronics, clothing, sports equipment, collectibles. Americans consistently underestimate how much dormant value sits in their homes. Many people raise $2,000 to $5,000 from a single serious purge on Facebook Marketplace and eBay, renting out a room or space. If you have a spare bedroom, renting it on a monthly basis could generate $600 to $1,200 per month, depending on your location. Even renting a parking space, storage space, or garage on platforms like Neighbor can generate passive income toward your down payment. Here is the critical rule for all side hustle income. Every single dollar you earn from side hustles goes directly and immediately into your down payment account, not into your regular spending, directly to the house fund. No exceptions, no rerotin, straight to the goal. One dedicated year of aggressive side hustling can add $10,000 to $20,000 to your down payment fund. That could be the difference between buying next year and buying in 3 years. Strategy number 7. And this one genuinely shocks most people when they hear it. There is free money available right now specifically to help Americans buy their first home. And the vast majority of eligible buyers never apply for it because they simply do not know it exists. Down payment assistance programs, DPAs, are grants, forgivable loans, and low-interest second mortgages offered by federal, state, and local governments as well as nonprofit organizations. These programs are specifically designed to help first-time and lower to middle income buyers overcome the down payment barrier. Let me give you the most important ones. HUD-approved down payment assistance programs. The Department of Housing and Urban Development approves and oversees hundreds of assistance programs nationwide. Visit HUD.gov to find programs specific to your state, county, and city. State Housing Finance Agency programs. Every single state in America has a housing finance agency, HFA, that offers first-time buyer programs. These programs often include below-market interest rates and down payment assistance grants that do not need to be repaid. That is free money for your down payment. The National Homebuyers Fund. This nonprofit provides grants of up to 5% of the loan amount for down payment and closing costs. No repayment required. You simply need to meet income guidelines and use an approved lender. Employer down payment assistance. This is the most overlooked source of all. Many large American employers, including some major corporations, hospitals, universities, and government employers, offer down payment assistance as an employee benefit. Check your HR department. You may have money available that you have never claimed. Local government programs. Many cities and counties offer additional programs on top of state programs specifically targeted at buyers purchasing in their jurisdiction. Some offer forgivable loans, meaning the loan is completely forgiven if you live in the home for a set number of years. The combined value of programs you might be eligible for could total $10,000, $20,000, or even more in assistance toward your down payment and closing costs. Research every program you qualify for in your specific location. This research alone could compress your timeline by years. Strategy number 8. And I promise you this one would be powerful. Most people saving for a house make one critical mistake with their down payment money. They leave it sitting in a regular savings account earning practically nothing, or worse, in a regular checking account earning literally nothing, while inflation quietly erodes its purchasing power every year. Your down payment money deserves to work harder than that. And depending on your timeline, there are specific investment vehicles that give you better returns while keeping your capital relatively safe. 4 down payment timelines of 0 to 2 years, meaning you plan to buy in the next 24 months. Your priority is safety and liquidity above all else. Your best options are high-yield savings accounts at online banks, currently yielding 4.5% to 5.5% annually. Treasury bills, short-term government securities that are completely risk-free and currently yielding similar rates. Money market accounts at brokerage firms. And certificates of deposit, CDs, if you want to lock in a specific rate for a defined period. For down payment timelines of 2 to 4 years, you have a bit more runway and can consider a conservative approach. A mix of short-term treasury bonds and high-yield savings gives you better returns without significant risk. Some financial advisors suggest a small allocation to conservative bond funds, but only if your timeline is comfortably beyond 2 years. 4 timelines beyond 4 years. Some Americans choose to invest a portion of their down payment savings in broad index funds and accept some market volatility in exchange for potentially higher returns. This carries real risk. Markets can drop significantly in the short term, but over 4 or more years historically, the probability of positive returns is very high. The absolute rule is this. The shorter your timeline, the safer your vehicle must be. You do not want to be ready to buy your house and find out your down payment dropped 30% because the stock market corrected. Match your investment vehicle to your timeline. Make every dollar work as hard as safely possible. Strategy number 9. This strategy has helped thousands of Americans get into their first home years ahead of schedule, and almost nobody talks about it. It is called house hacking, and it is one of the most powerful wealth-building real estate strategies available to first-time buyers in America today. Here is how house hacking works. Instead of buying a single-family home where 100% of your mortgage comes out of your pocket, you buy a small multi-unit property, a duplex, triplex, or fourplex. You live in one unit. You rent out the other units, and your tenants, partially or completely, cover your mortgage payment. Let me give you a real example. You purchase a duplex in a mid-size American city for $350,000. You put 3.5% down with an FHA loan, That is $12,250. Your mortgage payment, including taxes and insurance, is $2,400 per month. The other unit rents for $1,400 per month. Your actual out-of-pocket housing cost is $1,000 per month, and you own the building and are building equity every month. Compare that to renting an apartment for $1,500 per month, where you build zero equity and your landlord's wealth grows instead of yours. While you are house hacking, you're also saving dramatically on housing costs, freeing up more money per month to put towards savings, debt payoff, and the next property. Many serious real estate investors started exactly this way. One duplex, lived in one side, saved aggressively, bought the next property, and built significant real estate wealth over a decade, starting from a relatively modest beginning. House hacking requires a mindset shift, but for Americans willing to embrace it, it compresses the timeline to homeownership dramatically while simultaneously beginning their real estate wealth building journey. Build your emergency fund separately and simultaneously. This is critical. Your down payment account and your emergency fund must be two separate accounts. Your emergency fund, 3 to 6 months of living expenses, is what you tap when the car breaks down, not your house fund. If you do not have an emergency fund, build one alongside your down payment savings from the beginning. Celebrate small milestones. When you hit $5,000, celebrate. When you hit $10,000, celebrate. Not by spending money, but by acknowledging the progress. Change your phone wallpaper to show your current balance. Tell someone who will be excited with you. Track the percentage complete. Make the progress visible and real. Find your accountability partner. Share your goal with someone who will check in on you. A spouse, a sibling, a close friend, a financial accountability group. The research on goal achievement is consistent. People who share their goals and have accountability are dramatically more likely to follow through. Visualize the end result constantly. Find a picture of the neighborhood you want to live in. Save a listing of a house similar to what you are working toward. Look at it regularly. Feel the emotional reality of what you are building toward. The emotional connection to the goal is what sustains you through the hard months. The path to homeownership is not complicated, but it is a long road with temptations and setbacks along the way. The Americans who actually get there are not the ones who found a magic shortcut. They are the ones who decided that the goal was worth protecting and then protected it. Let me show you exactly what is possible when you combine every strategy we cover today. Scenario 1. Conservative approach. Save $1,000 per month using basic automation and budgeting. Reach $60,000 in 5 years. Scenario 2. Aggressive approach. Save $2,000 per month through budgeting cuts and moderate side hustling. Earn 5% interest in high-yield savings. Reach $84,000 in approximately 3.5 years. Scenario 3. Maximum approach. Save $2,500 per month through aggressive budgeting, active side hustling, and debt elimination. Add $15,000 in down payment assistance grants. Earn 5% interest. Reach $84,000 in under 2.5 years. The difference between Scenario 1 and Scenario 3 is not income. It is strategy. It is intentionality. It is the decision to use every tool available to you simultaneously rather than hoping that one approach alone gets you there. Are you going to start today? Not next month. Not when things settle down. Not when you feel more ready. Today, open that account. Set that automatic transfer. Write that number on your mirror. Your front door is waiting. If this video gave you real value today, please hit the like button right now. Subscribe for weekly videos on building real financial freedom as an American. And drop a comment below. What is your down payment goal right now? Tell me the number. I read every single comment, and I would love to celebrate your goal with you. Go get your house. I will see you in the next video.